What is going on right now with crypto? We are in a bear market, and the most dangerous thing about that statement is not saying it out loud. It's pretending we aren't. Right now, the market is stuck in a psychological tug of war, where liquidity headlines scream optimism while price action quietly confirms exhaustion. Bitcoin doesn't crash because people expect it to. It bleeds because capital quietly steps aside. That's exactly what's happening now. What is going on behind the scenes causing all of this? Let's dive in right now. So I need you, the amazing viewers, kick back, get comfortable, smash the like and subscribe button. Now, let's get right into the video. We just lived through a cycle where everyone was trained to believe that global liquidity automatically equals higher prices. But this cycle is exposing a harsh truth. Liquidity alone is not enough without conviction, participation, and follow-through. Bitcoin already suffered a brutal drawdown, and history tells us that midterm election cycles have a nasty habit of extending pain far longer than people expect. This is not panic territory, but it is acceptance territory, and acceptance is always where bear markets live. The smart money isn't asking if we're in a bear market anymore. They're asking how long it lasts, how deep it goes, and who survives with capital intact on the other side. What makes this cycle especially uncomfortable is that the usual bull market signals are broken. Retail participation is missing, leverage is muted, and volatility has been harvested instead of expanded. When you look across exchanges, funding rates remain neutral, spot volumes are thin, and speculative excess simply isn't there. That's not bullish, that's dormant. In prior cycles, euphoria was obvious. This time, apathy dominates. Bitcoin dominance keeps grinding higher because capital is hiding in the safest crypto asset available, not because confidence is exploding. Altcoins aren't being accumulated aggressively, they're being tolerated. That distinction matters. Markets don't trend upward on tolerance, they trend upward on obsession. And obsession is nowhere to be found. Every bounce fades because buyers are defensive and sellers are patient. This isn't a crash environment, it's a slow burn environment that quietly drains enthusiasm until only disciplined capital remains. Institutional participation has also changed the structure of this market in a way most people underestimate. ETFs brought credibility, but they also brought yield extraction. Instead of chasing upside, institutions are writing calls, harvesting volatility, and capping price action. This suppresses momentum and keeps Bitcoin trapped in ranges longer than anyone expects. When volatility becomes a product instead of a symptom, explosive moves become harder. Wall Street didn't arrive to gamble, it arrived to optimize, and optimization is not friendly to parabolic rallies. Without retail leverage pushing momentum and without institutions chasing price, Bitcoin becomes range-bound, heavy, and emotionally draining. That's textbook bear market behavior, even if price levels look deceptively high. The idea that institutions alone can replace retail demand sounds comforting, but the data tells a more sobering story. ETF inflows have slowed, and recent allocations are underwater. That matters more than people realize. Institutional risk committees do not increase exposure to underperforming assets. Momentum is king in portfolio allocation, and Bitcoin has lost its momentum edge this year. When performance stalls, enthusiasm stalls with it. Institutions don't buy narratives, they buy trends. And right now, the trend is indecision. That's why capital hasn't rushed in despite improved access, regulatory clarity, and media coverage. Accessibility does not create demand. Conviction does. Options, markets quietly reinforce this reality. Open interest has grown, but much of it is defensive. Covered call writing caps upside and dampens volatility. Long gamma isn't driving price discovery, it's suppressing it. Every rally becomes an opportunity to sell premium instead of chase momentum. This creates a self-reinforcing ceiling that frustrates traders and exhausts bulls. It also explains why price struggles to hold breakouts. The market isn't broken, it's being farmed, and a farmed market doesn't run, it churns. Global liquidity arguments sound compelling on paper, but they fail when applied mechanically. Money supply growth does not equal immediate crypto demand. Much of the recent liquidity expansion has been currency-driven rather than demand-driven. A weaker dollar inflates global liquidity metrics without injecting real risk capital into Bitcoin. Liquidity only matters when it actively seeks risk. Right now, it's cautious, fragmented, and parked. Stablecoin issuance tells the real story, and those flows have slowed dramatically. When actual crypto-native liquidity dries up, price action follows. This isn't theory, it's observable behavior. The Treasury General Account narrative has also disappointed traders repeatedly. Liquidity injections do not instantly translate into Bitcoin buying. Timing matters. Distribution matters. And most importantly, intent matters. We've already seen periods where TGA drawdowns coincided with Bitcoin weakness, not strength. Liquidity without narrative is noise. Markets don't move on balance sheets alone. They move on belief. Right now, belief is fractured. Monetary policy isn't providing the tailwind people hoped for either. Rate cuts have slowed, forward guidance has hardened, and inflation remains sticky. The Fed is closer to neutral than accommodative, which limits speculative expansion. Risk assets thrive on acceleration, not stagnation. Without a clear pivot, markets drift, and drift is poison for speculative assets like crypto. The historical pattern is clear. Rallies fade when cuts pause, and we are dangerously close to that environment again. Unemployment trends add another layer of risk. When unemployment rises above its long-term average, recessions often follow. Stimulus eventually arrives, but pain usually comes first. Risk assets rarely bottom before economic stress becomes obvious. That lag matters. Expecting immediate upside from macro easing ignores how markets actually behave under pressure. Liquidity saves systems, not portfolios. Midterm election years historically add further pressure. Political gridlock, policy uncertainty, and shifting power dynamics weigh on markets. Bitcoin has a track record of significant drawdowns during these periods. A 60% correction isn't guaranteed, but it's not unthinkable either. Key technical levels suggest downside risk remains if confidence fails to rebuild. Range-bound decay is still the most likely outcome, not explosive recovery. Altcoins face even harsher realities. Unlocked schedules, VC selling, and lack of compelling narratives weigh heavily. Without retail enthusiasm, altcoins struggle to outperform. Yield opportunities in traditional finance compete aggressively with DeFi returns, reducing incentives to rotate capital. Many projects feel stagnant, lacking the innovation spark that fueled previous cycles. Cheap fees alone don't create demand. Use cases do, and right now, usage isn't accelerating. Narratives have always driven crypto cycles. China adoption, DeFi summer, NFTs, and yield farming all pulled capital inward. This cycle lacks that catalyst. Storage isn't exciting. Staking isn't exciting. Institutional custody isn't exciting. Without excitement, retail stays sidelined. And without retail, altcoins languish. Markets don't move because something is logical. They move because something feels inevitable. That feeling is missing. Bitcoin dominance rising isn't bullish for the broader market. It's defensive positioning. Capital is hiding, not expanding. Until that changes, rallies will remain fragile. Selective assets with strong ecosystems and real yield may outperform, but broad altcoin rotations look unlikely without a new story. Influence in crypto has also shifted. This is no longer a founder-driven cycle. It's an institution-driven one. BlackRock matters more than personalities now. That brings stability, but it also brings restraint. Institutions don't chase chaos. They manage risk, and risk management caps upside. The hard truth is that bear markets aren't defeated by optimism. They're survived by discipline. Capital preservation matters more than bravado. The next true bull market will arrive when participation returns. Narratives ignite, and liquidity actively seeks risk again. Until then, patience wins, boring wins, survival wins. And the investors who accept that reality instead of fighting it will be the ones still standing when the cycle finally turns.